They told you it was a bubble. They told you it was speculation. They told you to take profits, rotate back into real assets, and stop being greedy. As if a monetary metal with 5,000 years of history suddenly stopped being real. First they said 50 was the top, then 60, then 70 was definitely the top. And anyone still holding, they said was a fool riding a generational mania straight into collapse. Now look at the screen. Really look at it. 79.30. Prices the world has never seen. No precedent, no historical roadmap, no playbook. This is not just another rally. This is not a technical breakout that will conveniently fade when sentiment shifts. What you are watching right now is a reset happening in real time, and most people will not understand it until it is already too late. While the mainstream financial media scrambles for explanations while talking heads warn about volatility momentum and profit taking, something far more important has already happened. Something quietly released, deliberately timed, and strategically ignored. Not in New York, not in London, but on the other side of the world, where decisions are made without press conferences or permission. And that single development confirms everything we have been saying for years. It proves that the physical silver market is approaching a breaking point. Not someday, not eventually, now. This is not about hype. This is not about retail traders or social media excitement. This is about power control and supply. It is about governments deciding who gets access to critical resources and who does not. It is about paper promises colliding with physical reality. Tonight, I am going to walk you through the most important policy shift in the silver market in decades. A move that fundamentally changes the rules of the game. A move that turns volatility into inevitability and scarcity into leverage. If you understand what is unfolding, you will not panic. You will be prepared. If you do not, you will be chasing prices and headlines while the real opportunity disappears. This is where the story truly begins. If this kind of analysis helps you see the market more clearly, type 1 in the comments to show you are paying attention, subscribe to the channel, and share this with someone who still thinks silver is just a trade. When you are ready, respond. 1 means continue to chapter 2. 2 means stop here. While Western markets were quiet desks empty and liquidity thin, something slipped through unnoticed. No press conference, no warning. Just a policy document quietly published by the Chinese Ministry of Commerce. Document number 68 of 2025, and what it contains fundamentally changes the silver market. This is not regulation in the Western sense. This is not guidance or oversight. This is control. In China, state trading means the government decides who is allowed to export and who is not. Price does not matter. Market signals do not matter. If a producer wants to export even 1 ounce of silver, they must apply, qualify, comply, and receive approval from Beijing. No approval, no export. Period. They did not impose tariffs, they did not raise taxes, they installed a valve. A choke point that can be tightened or closed at will, quietly, instantly, without explanation. China is one of the world's largest silver producers, mining millions of ounces every year. And now for the next 2 years, every ounce leaving the country is subject to state permission. That alone should make you stop and think. Silver is no longer just a precious metal. It is an industrial input China cannot afford to lose. Solar panels, electric vehicles, advanced electronics, energy systems. Their entire industrial strategy depends on it. Securing domestic supply is not optional. It is strategic. So ask yourself this: do you really believe China will prioritize Western paper markets over its own industrial future? Do you believe they will ship silver abroad so it can settle futures contracts and ETF claims? The timing was deliberate, released during Western holidays when markets were distracted and media coverage was thin. By the time traders fully process what happened, the supply picture will already be worse. This is not a shortage yet. It is something more dangerous. Supply has become conditional, political, unreliable, and once the market understands that, pricing dynamics change permanently. Now let us connect the dots, because this is where most people get lost. A supply restriction on paper looks abstract, technical, boring. But the consequences are anything but. When supply becomes conditional, every downstream participant starts acting defensively at the same time. And that is how panic begins. Industrial buyers, do not wait. for confirmation. They do not wait for headlines. They move early because failure is not an option. If you are responsible for keeping a solar factory running or an EV assembly line moving or a semiconductor fab online, you do not speculate. You secure supply at almost any cost. This is why the reaction matters more than the policy itself. The moment China signaled control over silver exports, every global procurement manager saw the same risk. Metal that was assumed to be available may not be available at all. Not next year, not at contract renewal, possibly not at any price. This is the point where the physical market begins to separate from the paper market. Futures contracts still trade. ETFs still show liquidity. Screens still update. But behind the scenes, the real metal starts disappearing into long-term commitments, strategic stockpiles, and private vaults. And here is the uncomfortable truth the mainstream refuses to say out loud. The silver market has always relied on confidence. Confidence that metal could be sourced when needed. Confidence that paper claims could be converted. Confidence that supply would show up if price rose enough. That confidence is now cracking. Once industrial buyers decide supply, risk matters more than price. The market stops behaving rationally. Demand becomes urgent. Inventory becomes sacred. And anyone short physical exposure suddenly realizes they are standing in front of a moving train. This is how orderly markets become disorderly. Not with a crash, but with a scramble. Not with fear at first, but with urgency. And by the time the fear shows up, the metal is already gone. This is not theory. We have seen this movie before in energy, in food, in chips. Silver is simply next. And unlike those markets, silver is smaller, thinner, and far less forgiving. To understand how fragile this market really is, you need to look at where the silver actually sits. Not the paper contracts, not the derivatives, the metal, the physical inventory that everyone assumes will always be there when needed. The heart of the global silver market is London. Vaults operated by major banks, clearing institutions, and custodians. On paper, the numbers sound large. Hundreds of millions of ounces, enough they say to meet demand, but numbers without context are meaningless. Most of that metal is already spoken for. It is allocated, it is pledged. It backs ETFs, industrial contracts, and banking obligations. Very little of it is truly free-floating. Very little of it is waiting to be bought by someone new at the margin. This is where the illusion breaks. The largest silver ETF alone controls a massive share of London Vault inventory. Add other funds, add industrial allocations, add private storage, and suddenly the pool shrinks fast. What looks like abundance becomes scarcity once claims are counted honestly. Now add one more pressure point. Futures markets are still offering delivery. Long holders are not rolling over. They are standing for metal. That matters, because every ounce delivered is one less ounce available to satisfy the next claim. For years, the system relied on one assumption: if demand surged, supply would appear. Metal would flow from producers, from exporters, from stockpiles. But China just made one of those flows unreliable. And when even one major source becomes conditional, the math stops working. Banks and market makers are now trapped between rising demand and tightening supply. They cannot print silver. They cannot conjure inventory, and they cannot rely on exports that require political approval. This is why the timing matters. This is why the price action feels different, because underneath the screen, the margin of error is disappearing. And when that margin reaches zero, the market does not correct. It reprices. This is the moment when the narrative begins to crack, when silver stops being treated as a monetary curiosity and starts being recognized as an industrial bottleneck. And that shift changes everything. Modern economies do not run on theories. They run on inputs. Silver is embedded in electric vehicles, solar panels, data centers, advanced electronics, and energy systems. There is no substitute at scale. When supply tightens, production decisions are forced. Costs rise, timelines slip, and executives panic. This is why the price is no longer moving like a traditional precious metal. Silver is starting to behave like an industrial necessity under stress. That is why it is outperforming gold. That is why the moves are faster, sharper, and more volatile. When industrial users enter the market defensively, price becomes secondary. Availability becomes everything. They are not trying to time tops. They are trying to avoid shutdowns, and once that mindset takes hold, demand becomes inelastic. Meanwhile, the paper market keeps quoting prices as if nothing has changed. Spreads look normal. Liquidity appears intact, but this is a surface illusion. Beneath it, physical premiums rise, delivery times stretch, and inventories quietly vanish. This is the divergence we warned about. Paper can trade forever. Metal cannot, and when the two separate, the paper price becomes irrelevant to anyone who actually needs the silver. This is also when volatility explodes. Pullbacks become violent, rallies become vertical. The market starts behaving less like a price discovery mechanism and more like a rationing system. And once rationing begins, there is no clean exit. Only higher prices and fewer options. That is the phase we are entering now. At this stage, the word you're going to hear everywhere is bubble. It always shows up right on time. When prices move faster than comfort allows, when charts look unfamiliar, when the old models stop working, the bubble narrative is deployed to restore psychological control. But bubbles are driven by fantasy. What we are seeing in silver is driven by constraint. A true bubble requires excess supply and reckless speculation. Silver has neither. Mine production has been flat for years. New discoveries are rare. Permitting is slow. Recycling cannot scale fast enough to matter. Meanwhile, demand keeps compounding through electrification, automation, and energy transition. This is not capital chasing returns. This is capital chasing survival. Every historical supply shock looks irrational in real time. Oil in the 1970s. Uranium during the nuclear build-out. Palladium when emission standards changed. None of those were bubbles. They were repricing events forced by reality. The difference matters. Bubbles collapse because supply overwhelms demand. Repricing events end only when demand is destroyed or new supply appears. And in silver, neither is happening. That's why technical indicators are being ignored. Overbought readings don't matter when the metal itself is scarce. Momentum doesn't fade when buyers cannot afford to wait. Traditional resistance levels fail when price is no longer the mechanism availability is. Volatility will be extreme. That part is true. Shakeouts will come, headlines will scream, but volatility does not equal weakness. In supply-driven markets, volatility is a feature, not a flaw. The people who mistake this for a bubble will sell too early. The people who understand the difference will hold through the noise and let the market finish its work. Now let's talk about policy risk, because supply is not the only pressure building. Governments are waking up late to a reality they ignored for decades. Critical materials cannot be sourced on demand in a fragmented world. In the United States, silver has quietly entered the conversation around strategic and critical minerals. That matters, because once a metal is viewed through a national security lens, markets stop being free and start being managed. Tariffs, restrictions, incentives, stockpiling, all of it comes into play. For silver, policy risk cuts one way. It tightens supply where it is needed most. If imports become more expensive or more regulated, domestic buyers compete harder for fewer ounces. Inventories that once flowed freely become regionally trapped. And price stops being global. It becomes local, fragmented, and unstable. This is how trade friction amplifies scarcity. A metal sitting in one vault is no longer interchangeable with a metal sitting in another country. Logistics slow. Compliance rises. Costs compound. And every additional barrier pushes buyers to secure supply earlier and for longer durations. Think about industrial planning in that environment. You don't buy just in time. You overbuy. You stockpile. You lock in supply even if it hurts margins, because the alternative is production failure. This is where the squeeze accelerates, not because speculators pile in, but because institutions cannot afford to be wrong. They choose certainty over price sensitivity, and when institutions behave that way, the market stops retracing. This is why the next phase will feel uncomfortable. Prices will gap, liquidity will thin, the old reference points will stop working, but none of that signals the end. It signals transition. The system is adapting to a world where silver is no longer assumed to be abundant, and once that assumption dies, it never comes back. This is the phase where hesitation becomes the biggest risk. Not volatility, not pullbacks, hesitation. Because once a market shifts from pricing to rationing, the question is no longer at what price, but will there be any left? People watching from the sidelines always tell themselves the same story. They wait for confirmation. They wait for a dip. They wait for the media to declare it safe. But in supply-driven markets, safety only appears in hindsight after the opportunity is gone. This is what I call the unobtainable phase. Dealers stop quoting firm prices. Inventory disappears overnight. Delivery times stretch from weeks to months. Premiums detach from spot and keep rising even on down days. You don't get a second chance because there is nothing to buy. We've seen this before: semiconductors, ammunition, energy, baby formula. When supply chains break, money becomes irrelevant. Access becomes everything. This is why the distinction between paper exposure and physical ownership matters so much. Paper trades can be paused. Claims can be settled in cash. Rules can be changed midstream. Physical metal in your possession does not depend on anyone else's promise. And this is where many investors make their final mistake. They assume liquidity equals safety. It doesn't. Liquidity disappears precisely when it is needed most. The people who prepared early don't panic. They don't chase. They don't need permission. They already hold the asset everyone else is scrambling for. That is the advantage of understanding the cycle before the crowd does. By the time the urgency is obvious, the window has already closed. For those who are already positioned, this is the most psychologically difficult phase. Not because of losses, but because of noise. When markets enter exponential territory, the pressure to act becomes constant. Every headline feels urgent, every pullback feels ominous, every rally feels unreal. This is where conviction is tested. You will see violent drops designed to shake confidence, 5% down days, 10% reversals. Analysts will appear on television explaining why the move has gone too far, why the smart money is exiting, why this is the top. They always do. Their job is not to help you. Their job is to stabilize perception. But fundamentals do not reverse overnight. Export controls do not disappear. Industrial demand does not vanish. Mines do not magically increase output because price moved higher. Supply crises unwind slowly, painfully, and unevenly. The biggest mistake investors make here is confusing volatility with reversal. In supply-constrained markets, volatility is the mechanism that transfers assets from weak hands to strong ones. It is not a warning sign. It is a sorting process. This is why patience becomes an edge. The ability to do nothing while others panic is what separates participants from winners. The people who understand why they own silver are not watching 5-minute charts. They are watching policy, inventory, and behavior. And behavior tells the story clearly. Buyers are still aggressive. Pullbacks are still shallow. Every dip is met with urgency. That is not distribution. That is accumulation under pressure. This phase does not reward perfection. It rewards discipline. The willingness to endure discomfort while the market reprices to reflect reality. If you can hold through this, you are positioned for what comes next. And what comes next is where most people are no longer invited in. This is where everything comes together. Policy, supply, demand, psychology. Not as theory, but as consequence. Silver is no longer being priced as a speculative trade. It is being repriced as a strategic resource. And that process does not stop at round numbers. What matters now is not whether silver pulls back 5 or 10%. What matters is that the structural conditions have changed. Export controls remain in place. Industrial demand continues to expand. Monetary policy is bending toward easing. Inventories are tightening, not rebuilding. None of the forces driving this move are temporary. Every major repricing event in history felt uncomfortable in real time. They always do. They force participants to abandon old assumptions and accept new realities. Silver is forcing that adjustment now. The lesson here is simple. Markets do not move because everyone agrees. They move because reality asserts itself. For years, silver was mispriced because supply risk was ignored. That mistake is now being corrected. If you own silver, understand why you own it. Not for daily price action, but for what it represents: scarcity, utility, and independence from failing promises. Volatility will test you, but fundamentals will reward you. If you do not own silver, recognize that the risk is no longer overpaying. The risk is being shut out. Supply crises do not offer clean entry points. They offer urgency, then absence. The strategy from here is clarity. Own what you understand. Reduce exposure to promises that depend on flawless systems. Favor assets that exist outside leverage politics and counterparty risk. This is not about fear, it is about positioning. The people who prepare before consensus forms are always accused of being early, until they're proven right. Silver is telling you something. China confirmed it, industry is responding to it, price is reflecting it. The question is not where silver goes next. The question is whether you act before the repricing is complete. If this analysis helped you see the market more clearly, subscribe, share this video, and leave a comment so others can find it. The window for preparation is closing, but it is not closed yet.